Well, thanks for tuning in to the talking point today. Frankly, the talking point today, if the markets would have reacted very negatively, would have been the Moody's downgrade, but it could still be because the market seemed to have shrugged off this downgrade almost quite vehemently. It just shows the undertone, current undertone of the markets. But as a result of that, the talking point shifts to whether this up move that we're seeing, this 900 to 1,000 point up move that we're seeing in the indices, is it a bit of an economy opening up, short covering led bounce back that we're seeing, which could get sold into because the economic realities might be different? Or are the markets pricing in some of the pain points already, even at the current valuations? Let's put that question across and more to Vetri Subramaniam. Needs no introduction, joins us right now on the show with his thoughts. Vetri, so good having you. Thanks much for taking the time out.
Good morning, Niraj. Good to be here.
Yeah, likewise. Vetri, what's your sense? I mean, the markets seem to have shrugged off this downgrade. Not that, I mean, it is just coming back to parity, and a lot of people have said that, rating agencies have stopped mattering to the markets too much of late. What's your sense?
Well, I think it's a combination of things, Niraj. Remember that Moody's rating was anyway slightly elevated compared to the other agencies, and in fact, it was a little bit of a surprise. If you remember, I think it was somewhere in the fourth quarter of 2017 when they actually unexpectedly came out and actually increased the rating. So in a way, I think they've sort of corrected that unexpected upgrade by going back to where they were, which was the lowest level of investment grade rating, and at parity with the other rating agencies. So I wouldn't really read too much into the movement of the actual rating. What's more interesting is the points that they've made relating to why they've chosen to act at this point of time. And while obviously they've claimed that it is not related to the COVID outcome, I think very interestingly, the two things they pointed to, which to be fair, they had already mentioned in November 2019 when they downgraded the outlook, is that India has an issue with the financial sector. And I think this is something that really policymakers need to think about more, and it really needs some addressing because we've allowed this to persist for way too long. So that is really my biggest concern when I look at what Moody's has come out and done.
Yeah. Yeah, well, clear and present dangers, I'm sure. Vetri, but the market seems to be in a mood of its own, right? I mean, at 9,000, I had enough and more experts coming in and saying that we are headed to 8,000. Either be short or be out. Don't be long. And typically, Mr. Market does, what it wants to do, and at times contrary. What's your sense of this momentum that we have at hand? And I'm not asking you to predict whether it can extend or no, but do you reckon that the market at some point of time will take cognizance of the economic realities and might temper its enthusiasm?
So, I think 2 points we need to keep in mind. It's not like our market is the only market which has bounced off the
Yeah.
lows. Without doubt, the US is really the Pied Piper. And I would say a lot of the markets around the world are literally just following that Pied Piper. I think in India's case, and perhaps why many of us are, genuinely sort of concerned or disappointed, has been that the extent of the fiscal response from the government as well as the sort of monetary involvement, not in terms of providing liquidity, but in terms of giving the system some bit of comfort on credit, has been slightly underwhelming. And therefore, I think particularly going back 2 weeks ago when they finished announcing that whole package, there was a sense of disappointment in the market. But I think end of the day, as I said, with the Pied Piper sort of playing out very strongly, all the markets have got a little bit of a leg up. And it won't be the first time, Neeraj, that I've seen a market where initially it really gets a leg up only because the market has become a little bit too pessimistic, and because positioning has moved too much to the bearish side. If you look at some of the data, the FNO positions outstanding at the end of May were pretty much at record low levels. And in fact, even the roll spreads had come down dramatically, suggesting that people had already moved either to the sidelines or they were short, perhaps, from a positioning point of view. So some of that may have certainly contributed. And the fact that we are now calling it Unlock India 1.0 is also perhaps giving people some hope that eventually numbers will improve from here. So there's always a little bit of mismatch between what the economy is thinking and what perhaps the markets are thinking. And I see a lot of commentary about why is the market going up. March 2021 GDP is going to be down 4 or 5%. But really markets, when you look at it, you have to think about what might happen in the future. Let's just play a small game. Let's say you actually looked at the GDP growth for the year ended September 21 and not March 21. Would it still be a decline? I suspect not. So I think, getting caught in this trap about, oh, we know that it's going to be a decline, so the market cannot go up. That's not the right way to think about markets.
Okay. So just a small follow-up, Vetri. I mean, we've seen the kind of interjection of liquidity that the Fed has done in the U.S. markets, and it's sloshing around. I think I was seeing a chart yesterday which showed the deposits with the U.S. financial institutions, record highs, right? And some of these is getting deployed. PE firms are very active, and all of that. And arguably, the economy will bounce back quicker than the others. At least that's what surveys by major brokerages show as well. India doesn't have that, right? I mean, we haven't seen major fiscal responses of sorts. I think the FI flows have been dull, and you guys, while at the margin have been positive, but have seen enough days in the month of May wherein the DI flows also have been negative. So, would this be a largely short covering led rally to your mind? And what would your stance be? Would you believe that? Would you put in large money to work right now, or would you tactically, if you had the choice, wait for better options?
So I think, Niraj, there are two things we need to keep in mind over here. One is how are investors looking at India from a top-down perspective, and is it
Right.
really an economy which is getting them excited today? They've been excited about it for many years now, and if anything, the outcomes over the last 2 years have perhaps been disappointing to them. But
Yeah.
let's not lose sight of the fact that I think many investors who've got long track records in India have also experienced that if you're able to buy the right company in India, you can make returns which are very different from what the benchmark returns might be. So even if you look over the period of the last 1 month, when there have been large companies doing issuances which by no stretch of imagination are small, the books have been massively oversubscribed. And then what that's telling you is that there is still demand for good, strong quality Indian companies. And if anything, this crisis might actually enable them to grow even faster over the next few years. So I think you have to keep this dichotomy in mind. There are genuine concerns about India's macro, but there are many investors who are willing to take a bottom-up bet on strong Indian companies. And just look at the kind of news flow we've had in terms of companies raising money from the markets or even secondary transactions. I think that's a sense of the kind of confidence that people have in a few Indian companies, maybe the macro a little bit more challenging. On the second part of the question you asked, which is about, how does one deal with this? Eventually, from our point of view, I've been looking at flows in the market for 30 years now. And honestly, it's impossible to figure out what the flows will be at any point of time. So we prefer to look at valuations as our guide to understand where we should be incrementally positive on the market and where we shouldn't. But that comes with a caveat. We run fully invested equity funds. So we don't really take asset allocation calls in our portfolio, at least at UTI, on average, our portfolios are always 95% plus invested in the market. We do run one asset allocation product which uses a combination of metrics to determine whether the market is attractive. And Neeraj, it's quite interesting. Throughout 2019, that product, based on its model, was running an equity allocation of under 50% because all the indicators were saying the market is not attractive. You fast forward to the first week of March 2020, when the market starts selling off and the portfolio suddenly starts, the model tells us to increase allocation. In fact, we've gone from 50% asset allocation in equities in the last week of February to 80% equity allocation in the last few weeks, because that is what the model is telling us. So I think the big opportunity, honestly, was in that late March, early April. But if I look at it in the context of history, markets, both on a trailing PE and on a price to book, are well below the long-term average. And I would particularly highlight the price to book. In fact, it's one standard deviation below the long-term average, even as of May 31. So to my mind, there is still attractive plays available in the market. Not as attractive as it was when the Nifty was 7,500, but it's hard to argue that there is nothing attractive in the market. I think we do find value in many sectors and also, across the market cap spectrum.
Yeah, I think the last that I calculated, the trailing price to book for the Nifty 50 was just a few points away, shy of October 2008, actually 20 or 30 basis points, if I'm not wrong. But anyways,
Yeah,
the point well taken.
At the low, in fact, Neeraj, it went down pretty close to that
Yeah,
level.
yeah.
And the point I want to make here is that it's always going to be the case that when visibility about the future is extremely hazy or low, is when you get attractive valuations. And the price to book is a great way to think about valuations. Don't get trapped about in the price to book methodology, but it tells you that you're only paying for something close to the asset value of the business and not for growth premium. That is when I want to pay for the potential that the business might actually grow. I don't want to pay for growth when people are dangling reports in front of me saying India will be 10 trillion, 20 trillion, world's third largest economy. That's typically the time the valuations have already gone through the roof.
So, is there where you find value? I mean, where do you find value in the market currently? Are you looking at asset owners and price to book multiples, or I'm guessing you're not looking at high growth, right?
So honestly, as I said, don't get trapped in the price to book beyond a point. It just gives you an indication that you're not paying for too much growth. Honestly, we find the whole idea of buying companies only on price to book quite limiting, because eventually we make money only if the enterprise grows
Growth.
and it reinvests capital
Yeah.
at a rate of return higher than cost of capital. So we want growth in the businesses that we invest in. Now, where do we find value today? As I said, if I were to look at it at a sector level, auto is one area where we certainly start to see a lot of value in some of the companies there. Again, if you look at them on price to book, they've derated quite significantly. They're not bargain basement cheap, but the thing we like about auto is that they've actually been in a downturn now for almost 2 years in terms of sales, right? Their problem started going back in the festival season of calendar 2018. So we think the inventory is now pretty much cleaned out. The stocks have derated. Nobody is thinking about growth because obviously this year is challenging. But many of these companies have extremely strong balance sheets, rock solid, no debt issues, and therefore we think this is a great time to be building positions in that automobile sector if you have a view which is about 3 to 5 years out, because we still think automobile is a growth sector in India. Across categories we are significantly underpenetrated. So that's an example of a sector where I would say incrementally we've turned a lot more positive in recent weeks or months. Pharmaceutical is one area where it's been positive right through financial year 20. Honestly, it was a very painful position for pretty much the first, I would say almost till January 2020. But in the last 3 or 4 months, it's done well enough to sort of compensate for the earlier pain. It's not something where we are incrementally adding money, but we're happy to kind of stay invested where we are at this point of time. So, but that's our thinking. Look for where the market has now become extremely pessimistic about the growth outlook, because there are some areas where we think, given India's medium-term growth trajectory, there will be a return to growth. What we need is to pick the stocks that can survive and that have balance sheets that can navigate a challenging period. And we don't know how long that challenging period is. It might be 6 months, it could be 1 year, it could be 1.5 years. We don't know where that is. But if they have the balance sheets to navigate, we think they'll come out stronger and eventually get the benefit of the growth.
Okay, so starting factor is a pristine balance sheet, if you will, and then go on to try and think about growth. Just wondering whether analysis of what the post-COVID world could be, and it'll be anybody's guess, right? Because nobody has a clear answer out there. But some analysis, some trying to think of the future, does it throw up newer names, newer sectors, or newer themes, if you will?
It could, Niraj, and I'm sure the world has undergone changes, and there will be dramatic changes. But I'm not going to be soothsayer and try to figure out what they are at this point of time. I also think that humans are very strange animals, if you want to call it that, right? I mean, we've seen reports of how in Bangkok and in Manila, when they reopened the malls were jam-packed and people were sort of thronging back in large numbers. You've seen photos from the US going back a week, whereas they opened, restaurants and bars were filling up like there was no tomorrow. So let's see. I think we shouldn't get too carried away that everything has changed. Some things have changed. We are still at a position where we are trying to understand what has changed, but I don't want to be soothsayer and make those bets too early. We are willing to be patient investors. The thing that allows us to be patient is the strength of the balance sheet and the strength of the cash flows. If that becomes a challenge, we will review some of our investments. But otherwise, we are not making any dramatic calls at this point of time to say that the world has changed and few businesses will not look like what they were earlier. Perhaps they will, but we'll get there when we get there.
Yeah, I'm a culprit too. I mean, for the first time that Mumbai allowed the non-essential shopping online, I went and did it yesterday just to get that feeling, Vetri. I think everybody will be missing that. Okay, a small follow-up, Vetri, on financials, and there's a bit of a conundrum here, simply because everybody knows that sector is having issues. That is fine, but everybody would probably agree as well, and maybe you would agree too, that we can't grow without financials being there, right? So therefore, would you believe that even if the overall weightage comes down from the heady, and it has already come up, but let's say it continues to fall, the some of the better franchises could actually grow in strength, in size, and actually grow in acceptance in the investors' minds as well. So we may well have a sector which is moving off, but some of the entities actually doing even better than what they've done. Is that a possibility?
I think you hit the nail on the head over there, Neeraj. I think there are two things we need to keep in mind in financials, right? Eventually, everybody's problems land up in the books of the financials, right? So that's the
Yeah,
reason
yeah.
why the market is obviously extra cautious at this point of time and rightly concerned. B, there could be capital calls. Remember, we are looking at capital calls coming from companies across sectors at this point of time. And certainly, if there's pain on financial companies, we've seen this before, the same thing will play again. There will be more capital calls. So, again, that's a reason to be a bit cautious. But I think you're absolutely right. Uh, I think there is a clear opportunities for some of the financial companies, be it banks or NBFCs, but it's a very tiny lot, I would say, where they have got the benefit of the confidence of depositors, they've got the confidence of the bond market,
Mm-hmm.
and they've got reasonably strong capital adequacy, right? I think these three things, when they come together, means that these institutions, as the economy starts to normalize, can actually put their foot on the accelerator and drive way ahead of the competition, because a lot of the competition is actually be going to looking inside, trying to set their house in order because they've got a fire burning in their house. They don't have the opportunity or they don't have the ability to compete aggressively in the marketplace. So I think those few institutions, and maybe it's a handful, I think I could count all of them on the hands of my fingers of my hand, but they enjoy the confidence of depositors. They've got the track record of coming through cycles of credit fairly well, and they've got strong capital adequacy. I think they will come out of this with their foot on the accelerator and growing even stronger. Financials will be a key part of our marketplace. We are sort of slightly underweight in many of our strategies in the financials area, partly because we are concerned about this capital call issue, but we are very happy in some of the names where we think they can come out. We've got strong active weight positions in those names.
Okay, interesting. The other question, Vetri, is around just one more sector question, and then we'll move on to other things as well. One couple of last questions. What do you do with consumption? The staples, durables, non-durables? What's your sense there? Because some of the obvious ones seem fairly lofty on valuations.
You're right. So when you look at consumption, I think pretty much it's gone to two extremes. You've got the staples who are a lot more stable, and they've sort of held up in terms of prices and valuations. And then you've got the discretionary, which to a large extent have seen a dramatic correction. My bias is always towards seeing where the market has become unnecessarily pessimistic. So to be fair, we are finding more opportunities on the discretionary space, less so on the staples or the FMCG, classic FMCG products. So my bias as a value investor honestly would be to look more in that area of where companies have already seen the damage in terms of valuations.
Okay. Um, Just try and repatch that line, maybe. I think there's some connectivity issue, but we'll just try and get that sorted in a minute. But just keep in mind, I think what we've traversed thus far with Vetri Subramaniam is thought process that he has around the current scenario and themes that he's betting on, themes that he's looking for, both on a valuation as well as growth perspective. I was just talking to him about staples, and I think he was talking about Vetri. If we have you back, sorry, you got cut midway, but I think you were talking about the two extremes and what do you therefore see positively and see negatively, crudely put.
Yeah, so my tilt as somebody who's always got a bias towards value is honestly to look more at that discretionary space, not so much in the staple space. But that's really the way I think about it.
What worries you, Vetri? If there is anything that keeps you awake at night?
So I think one of the things that we need to worry about is the fact that we've allowed the financial sector imbalances to continue far too long. We're coming up to almost 2 years since the ILFS episode. If you look at any measure in the market, credit spreads are extremely elevated. And I think this is an area which certainly needs a lot of intervention from the government. And this will also be very critical in terms of determining the trajectory and the angle at which we have our recovery. So to my mind, the financial sector, though, even though we could have an outcome in which some institutions come out stronger, that's not necessarily good from a country or an economy perspective. That could be good for making money in a stock, but that's not great for the economy. So to my mind, it's really these financial sector issues which continue to plague us. I think many ideas are already out there. There's, should there be a bad bank? Should there be some kind of credit guarantee system? Is there a way to fast track? Though I know we've had to delay the whole IBC in recent weeks and months. But I think that is the area which still gives me grave concern, because I think the escape velocity and the speed and trajectory of recovery depends on how quickly we can fix the financial system.
Okay. Anything that I haven't asked you with that you want to comment on? Maybe an interesting excerpt that you guys wrote, something that you came across, anything that I haven't asked you.
Really, the other point that I would make here, Niraj, is more about, when you think about across the market cap spectrum, as I mentioned earlier, to be fair, there are opportunities that we now see in the small cap space, in the mid cap space, and in the large cap space. So even though we talk about strength of balance sheets, I don't think that should be interpreted as saying the only opportunity lies in large cap companies. We do see opportunities even in the mid cap and the small cap space, where there are quite a few companies who've got rock solid balance sheets. They've seen valuation corrections. They've seen a downturn in, obviously customer footfalls and so on and so forth. But we think there is value even in those mid and small cap spaces. So, we think that's also an attractive space to look at.
Okay, great. It was a pleasure chatting with you today. Thank you so much for your time. And we look forward to have you more often on the BloombergQuint platform.
Sure. Thank you, Niraj. Thank you. And
pleasure is ours.
Thank you on the team. Bye-bye.
Thank you. Viewers, thanks for tuning into this edition of The Talking Point.